NASDAQ, it's only up 0.2%, but this would be the 12th straight day, the first time that's happened in years. So that is quite the streak we got going on. Also, large cap tech about to notch its 12th day, and the Philly Chip Index. So semiconductors still running pretty strong here. Here's the S&P 500 up a little bit less than the NASDAQ. All three indices seeing a really choppy action today. Russell 2000, same story, just barely below the flat line there. And I do want to point out the transports have been on fire again, up 3.6% to another record high. And here's the Philly Semiconductor Index. I said they were up 12 days straight. Guess what? That is another record high. It's been something like 7 in a row for them. Meanwhile, we got software. We're going to talk about that in a little bit. Software is up 1.5%. Before I move on, I want to point out to something I was noticing under the hood in the market. So yesterday, the S&P 500, that was Wednesday, notched its first record high in several months. Now, this chart is of the S&P 500, goes back to, it's about 2 years old. And we also have the S&P advanced decline line there. That's in green. And what that is, it's a running total of all the stocks that are going up minus the ones that are going down. So basically, it's kind of like a confirmation engine for the S&P 500. Now, last year around the April Liberation Day sell-off, we saw, it was interesting, market internals peaked first, and then they recovered their own high way before the stock index. So that's what market internals did. Here's what the S&P 500 did, peaked afterwards, and eventually it confirmed. So the key word there is confirmation. So far, we only have the S&P 500 back up to records, and we want to see those market internals, that breadth movement, so signaling participation, we want that to rise. Hasn't happened yet. If it doesn't happen and we see the market start to roll over, that is a huge bearish warning sign. So moving on, I just want to get to some of the large cap sector action, and then I'll show you the NASDAQ 100, and then I'll pass the baton back. But here we have energy. We haven't seen energy leading in a while. It's been taking a hit over these last 12 days. It is leading today. Then we got communication services and tech, each of those up 1%. Real estate, materials, staples rounds out the top row. To the downside, healthcare, consumer discretionary, industrials, and financials all taking some hits there. Now, here's NASDAQ 100. Big change from yesterday. Yesterday was all green, especially the mega caps. Microsoft up 2% today. I said software is strong. AMD, though, up 6%. And we're seeing kind of a mix of red and green. And I will show you the Dow as well. There we go. Aside from the mega caps, we're seeing some strength in Chevron up 1.4%, IBM up 2%, and Verizon up 3%, Josh.
Jared, before I let you go, you mentioned software.
Yep.
Just pull on that thread a bit more. What's going on there?
Yeah, let me just show you a comparison what's happened over the last 12 trading days. So this is since that March 30th bottom, and you can see the iShares Semiconductor ETF is up 30% there. This is what it's been doing over these 12 days. Meanwhile, the software ETF, IGV, only up 8%, although that's a very respectable rally. However, this week, starting Monday, basically since last Friday's close, we've had a reversal in leadership. And here you can see IGV software up nearly 13%. Meanwhile, the SOX, Philly Chip Index, that is up about 5%. So you can really see what's happened in our heat maps over the last 4 days. I will show you software. Boom. And you got a lot of dark green there. Oracle up 28% versus semiconductors. You see some red there. There's a lot of green, but also a bit of red mixed in. So software is really coming from behind right now.
All right. Thank you, Jared. Well, the largest U.S. banks have just reported their latest results, seeing another quarter of rising profits. And Yahoo Finance's David Hollerith joining here with more. All right, David. So big banks report. What do we learn? I mean, it sounds like they're just kind of plowing right ahead here.
Yeah, so I mean, at a high level, they made $47 billion in profits between the big six Wall Street banks. So that's pretty good. It's a 12% increase from the year ago period, so first quarter of last year. And the three main takeaways we got is that, I guess, one, sort of a delicate dance around private credit right now. Two, Main Street is hanging on pretty darn well. And three, in Wall Street, everything is go, go, go.
About private credit risk, what did they say there?
Yeah, so it's like I said, it's a delicate dance. You know, Jamie Dimon, who's previously sort of warned about the credit market, he made an argument on the earnings call and in the media conversation on Tuesday, and he basically talked about the size of the private credit industry and how that relates to the rest of the debt markets and how that, in general, it can't really become a systemic issue in and of itself because of the relative size to the rest of the debt markets. But he also, JP Morgan and the other money center banks also revealed their exposure to the private credit industry, and it's not small. So in general, there's a lot of the bank executives need to move back and forth between talking about how they are well insulated, but they do have exposure. But they also, Goldman Sachs CEO, for example, saying, it's a business that looks good to them long term, and they want to stay in it. Ted Pick, Morgan Stanley CEO, said, private credit's in its adolescent phase. And so in general, they kind of had some pretty positive things to say in terms of the reactions we've seen from investors trying to get out of these private funds over the last quarter, largely saying that it's been overblown. But that being said, Diamond and CEO David Solomon both kind of reiterated the fact that a larger downturn in the credit markets is a serious risk, and that would obviously include the private credit industry.
On the consumer, at least the comments I was hearing from those big bank CEOs, it was sort of like they kind of, and tell me if I was hearing it right, to me it sounded like they were saying no real change. Like broadly, when they were asked directly, they kind of said, listen, broadly healthy, resilient, hanging in there.
JP Morgan was talking about on the call about compared to last quarter, the economic picture in terms of the consumer actually looked pretty decently. Now, the big thing here is that oil prices have gone up and gas prices have gone up as a result, but that really happened in March, so they only had 1 month to see that, and it's reasonable to think that it would take more time for that to get to the consumer. And a lot of the bank executives talked about the scenarios that if gas prices stay higher through the summer into the fall, that's kind of a different picture than what they saw now. But on just credit cards alone, spending was up across the credit card banks. Wells Fargo, Citigroup, JP Morgan, Bank of America, and 90-day delinquencies, which are actually an indicator for credit card defaults later in the next quarter, were actually down year over year too.
All right, sounds good, Dave. Thanks, appreciate it. Well, Pepsi shares are getting a pop after the company's Q1 earnings beat estimates. Let me kick it over now to Yahoo Finance's executive editor, Brian Sozzi, where the company's CEO joins us now.
All right, thanks so much, Josh. Yeah, very much focused on PepsiCo after that better than expected quarter. I want to welcome in PepsiCo Chairman and CEO Ramon Laguarta. Ramon, always nice to see you, my man. So
Hello,
the market liked this quarter, and I think the market really liked what you said about your food business. There was an acceleration there. For those not familiar with what you have done to turn this business around so quickly, what have you done exactly to get things going on the right trajectory?
Good. Hi, Brian, by the way. Listen, we talked about it early last year. We had a new strategy. We call it Hungry and Thirsty for Growth. It's holistic, right? Giving the consumer more value, executing better, transforming the portfolio with more functional, more permissible choices across food and beverages, making sure our international business continues to grow at a mid-single digit or faster, and then a lot of focus on away from home. All of this is what's driving the better performance of the company. We're very happy with the, we grew 8.5% top line, 2.6% organic, the rest, some of the acquisitions and some Forex, and profits grew 9% as well. So good. Now, when you go down to the food business, we're very encouraged by the performance. We grew volume 2%. We grew our units 4%. Almost 300 million additional occasions in Q1 versus last year. So, all this comprehensive, holistic value, space, innovation, away from home, some of the key brands restage is what's driving the business, and we are encouraged by also how the second quarter is started.
Is the biggest factor here, Ramon, that PepsiCo has dialed back some of the price increases that you took during the pandemic, and really this was the first taste, no pun intended, that those price cuts, whether it's on Doritos, Tostitos, you name it, the consumer's noticing that.
For sure, Brian, there is an element of affordability, not only reducing prices, but making sure that we have the right price points for different occasions, and that is bringing consumers into the brands. However, as I said earlier, I think it's much more than that. It's about space. It's about how we're restaging some of the big brands like Lay's and Doritos, big brands globally. It's about how we're bringing innovation with more functionality, with more permissibility into the marketplace. And we have great examples with Naked, for example. Naked is a very incremental innovation for us because it gives no colors to our favorites. So the great taste now with no colors. And moms are saying, well, this is great for my kids. And we're seeing that in moms with younger kids, in some cohorts, some households that they're coming back to the category where they were sitting outside of the category, and now they're participating. So listen, we're happy on its holistic transformation of the business and the acceleration that we got in Q4 now continues in Q1, and we're seeing good trends for Q2.
Ramon, when we had this conversation back in February, you told me, Brian, we're cutting prices. I'm like, okay, that's good. I imagine they're going to have some momentum. Things are going to look better when they report 3 months from now. And frankly, I was right, and you were right. Are you still going to cut prices into the summer?
Yeah, the value is going to be in the market, throughout the year, and the new price points are the new price points. And we believe that this is an element of the overall business growth strategy. Now, the big enabler of all this is our strong productivity. Without the strong productivity that we put in place, now it's already multi-year, but we see even accelerating, is the reason why we have all this optionality that other companies might not have on our food space. So the productivity is helping us to provide value, invest back into A&M. Our A&M is growing, is helping us to build these new platforms that will be growth areas for the future, is helping us to invest in away from home and get new occasions. So all this is enabled by a very strong productivity journey. And we're seeing that this is not a 1 year, 1 quarter kind of event. It's a multi-year strategy on productivity, automation, network, the design to value, global shared services, deploying AI against the business, a lot of drivers of productivity that will continue and will give us optionality through the summer, but beyond, obviously.
Ramon, I'm sure you saw this story. I think it was the past week on how PepsiCo is selling $7 bag of Doritos. I'm like, that's not the PepsiCo that I know. I mean, when you see things like that, what do you tell your team?
Oh, the team, we realized that we had opportunities with the value to some, to some consumers a year ago, and that's why we were very aggressive with productivity, and we continue to invest in making sure that every consumer has the opportunity to be in our brands. We give them the right value, we give them the right functionality, we give them the right availability, the right convenience, and that is the success formula for the coming years.
We have seen, since we last spoke, Ramon, gas prices have gone up. They have gone through the roof. They're still over $4 a gallon. I know the stock market is looking past all this stuff. It's at a record high, but the reality is consumers are paying a lot more to live every single day of their lives. Have you seen an impact on the business from this?
Not yet, Brian. And I must say, obviously, we're looking at this every day globally, not only the U.S., but globally. And we're seeing the consumer quite resilient, very resilient. And they're making choices, obviously. They're adjusting their budgets. They're stretching their budgets. We're seeing looking for value, looking for convenience, functionality. They're embracing digital in a big way because they see digital as a tactic to, maximize their budgets, compare prices, making choices. So we're seeing a lot of behaviors. Nothing different so far between March, April versus what we saw earlier in the year. And we're observing this over time. Now, obviously, if the gas prices continue to be at a high level, consumers will continue to make those adjustments. We estimate that energy or gasoline is about 3 to 4% of a household's budget. Food is about 15%. So they have a lot of other areas where they can, optimize their budgets, make choices, discretionary budgets they might have to optimize. But we're observing this very, very closely. But we haven't seen anything yet that we would like be surprised or change our position in the marketplace.
We didn't we didn't see a lot of, let's say, per se, inflation in your business as a result of the Middle East conflict. Is there a wave of inflation coming to your business over the next couple of quarters because of what we have seen in various energy markets?
Listen, we're clearly seeing inputs, energy related inputs and agriculture related inputs going up in some parts of the world. Fortunately, we're well hedged. It's a program that we have a lot of discipline, 6 to 12 months, depending on the input. We're also have the very resilient supply chain, global supply chain. That's how we benefit from the scale of PepsiCo, and we've built a lot of resilience, a lot of redundancy in our key materials. So far, we are not seeing any inflation. We're seeing a good flow of raw materials to our business. So that's where we stand. That gives us a bit of time, gives us 6-8 months to understand the scenarios and to see how we approach 2027, 2028, depending on how the situation unfolds. So far, as I said, we're accelerating in Q2. We don't see a lot of consumer behavior that is different from what we saw earlier in the year, and we're managing very well the raw material flow, and and hedging gives us a time to think, time to plan scenarios, time to make the best choices for how to continue to drive our strategic intent, in spite of this new situation.
Somewhat getting lost in this earnings release, Ramon, it's the major changes you're making to Gatorade. How large is the Gatorade business at this point, and why are you making some of these changes?
Yeah, listen, the Gatorade business is very scale. Is our second brand after Pepsi in the U.S. Business, and it's very large also in markets like China, Mexico, Brazil, and some of the European markets. So it's a big global priority for us. Now, what we're seeing is that hydration is a need state that is not well understood by consumers, and that by us being better hydrated, we perform better not only when we play in sports or after we go to the gym, but in everyday tasks. And that is what we're trying to do. Take the science of Gatorade that we've learned through many years of understanding athletes and make sure we put this at the disposal of everybody in multiple occasions throughout the day. We're trying to help consumers understand. So we're segmenting the portfolio, hydrating faster than water, hydrating better than water, and hydrating longer than water. And that longer than water is actually a big innovation. It means that we drink and because of the formulation that we provide, that hydration stays in our body. We don't need to drink for a longer period of time. That is very helpful for certain professions, for certain occasions where I think this will be very incremental. And that's the opportunity. So hydration as a need state, Gatorade and Propel as two big brands that provide science, provide solutions to amplify the addressable market and continue to give consumers solutions, whether it's liquids or powders or other means to live better lives.
Ramon, I'm waiting for you to bring back the iconic Gatorade glass bottles. I grew up drinking Gatorade out of glass bottles.
Here we
Not
go.
even in the cards.
Yeah, this is obviously a short-term marketing event, and yes, we want to use any tool in our disposal to make sure that consumers re-engage with Gatorade and that becomes part of their lives. And this is something we're doing with, this restaging of big brands is a way for us to keep refreshing our core business. We did it with Lay's, we're doing it with Tostitos, we're doing it with Gatorade, and we're going to do it with Quaker towards the end of the year. And keeping these brands alive, refreshed. We did it with Pepsi a couple of years ago. It's part of our, how we keep the business fresh. Then we overlay to that innovation into new spaces, in functional, permissible spaces, and we grow occasions then in away from home and international, being that the comprehensive growth strategy for the company, and that's why we feel very confident about our future.
Always good to see you, Ramon. I like those new protein Doritos. They make a lot of sense to me, and they taste great. I'll talk to you soon.
Ciao. Thank you very much, Brian.
Appreciate it.
Nice
Josh,
to talk
back to you.
All right, thank you, Brian. Coming up, the New York Fed president is casting new warning signs on the U.S. economy. Stay with us. The New York Fed president says conflict in the Middle East has introduced substantial risks to the U.S. economy. Yahoo Finance's Jennifer Schonberg has been following the latest Fed speak. Jen.
Hey there, Josh. That's right. New York Fed President John Williams warning earlier today that the U.S. economy could face a major supply shock from the conflict in the Middle East, pushing up inflation and pushing down growth. Williams says this has already begun to play out, and that while the data have not yet pointed to significant broad-based supply chain disruption bottlenecks yet, he is still seeing increased disruptions related to the supply of energy and related goods.
All right, some difficulties there. We'll try to get back to Jen in just a second. Meanwhile, we move on with inflation reheating at the edges and consumer sentiment hitting an all-time low. We're reassessing the consumer playbook with Zacks Investment Management Chief Market Strategist Brian Mulberry.
I think what the American people are feeling.
Got Brian there?
I'm here, Josh.
Brian, we're going to start with you real quickly. Let me get your general take, Brian. Apologies for the glitch there. Start with your general take on the American consumer, Brian. How healthy, how resilient, or does it depend, Brian, on which consumer we're talking about? Low, middle, high?
Yeah, probably more the latter. The K-shaped recovery that's in the consumer market is real, and we're seeing that, high-income consumers are doing just fine, but there's growing stress on the low-income side, and they're starting to search out for greater value. We just heard from the Pepsi CEO talking about the success that they're having engaging with, presenting better value, a little bit more for your money, if you will, and that's the way to approach the consumer at this point in time, that we're still seeing substantial spending on the high-income side, but things are starting to get a little bit more picky on the low-income side.
So let's talk about, given that backdrop, Brian, given your view of where things stand broadly, let's talk about where some opportunities are. You say Walmart is a buy, and you talk about operational excellence. You mentioned the data analytics. Is that the story, Brian?
It absolutely is. So what you're finding from Walmart is they're able to grow an already huge pile of revenue, $180, $190 billion every quarter in top line revenue, and they're growing that by 10%. And that's because they're getting more wallet share, but also increasing digital traffic. So now they're competing on equal footing with Amazon for home delivery of everything, and they have the advantage of always having that generic parable of all of the items that they offer on the shelf. So they're having a great experience in engaging both those high-income consumers as they want things delivered at home and name brands, but also the folks that are being a little bit more cost-conscious can shop for the generic alternatives on the shelf. So they're executing their new e-commerce and digital strategies incredibly well, and it's reflective of the growth of earnings that we're seeing over the next year.
Brian, the stock has had a nice move. It's up nearly 40% here over the past 12 months. But I'm assuming, Brian, you'll say, listen, in your opinion, valuation still attractive here?
Absolutely. So looking at the PE, it's at 45, and you might think, wow, that seems to be a high valuation. But when you add back that 10% earnings growth, the PEG ratio is still really attractive relative to some of its other peers in the space. An example would be Target, right? When you look at Target kind of declining earnings there. They are having a little bit of a renaissance the last couple of weeks because the new CEO is trying to turn things around, at least visibly to the market, but the execution on the balance sheet is lagging. Earnings, very small growth, around 3%. And so when you look at their PE ratio of around 20, their PEG ratio is still north of 5. So that still makes Walmart even a better technical buy in this moment in time.
You also like TJX, Brian. You say the business model translates well to consumers right now. How so?
Well, they offer obviously name brand goods at discount prices. And one of the biggest advantages they have that protects their margins is they're not really paying the higher input costs. Things are already onshored somewhere else, meaning that they pay the higher fuel cost of delivery, but also any tariffs or duties that might be involved in the process of onshoring those types of products. So consumers can go there, enjoy the discounts, and not have to pay all of the extra fees to make that TJX profitable. They're doing a great job of engaging, providing that sense of value where you get really good name brands at a big discount, and that's really relating to both sides of consumer spending right now.
In terms of names you would avoid, Brian, no love here for Lowe's. How come?
Really, again, one of those things where customer engagement is down. When you just look at, same store foot traffic, they're down. They're just not connecting with consumers in a way that's showing that they have enough value. The bright spot is in their pro segment, where they are having a little bit better engagement with contractors. But quite honestly, Josh, that's just spillover from the mega success that Home Depot's been having. So there's such a backlog of wait times for contractors at Home Depot. They're having to go to Lowe's to get bulk stuff there. On the retail consumer side, Lowe's is losing that foot traffic game. And if they end up having to discount some of their prices on the shelves to get more people in the stores, again, you can just see how that adds pressure negatively to their future profitability.
And then there's Target, Brian. You mentioned that one earlier, but pull on that thread for me. What's the issue there? Why would you avoid that one?
They're just consumers at Target, the old guard customers have kind of transitioned to Walmart because they just don't understand what Target's brand is anymore. We know that coming through COVID, they had to make a decision on how they were going to handle their oversupply of goods that just didn't sell during the pandemic because you couldn't go shopping, right? And they ended up discounting a whole bunch of stuff. And that changed the business model in consumers' minds now 5 years later, where they're still waiting for Target to have a big discount sale. That's not the model that Target wanted. They spent 25, 30 years trying very much not to be Kmart, but now they've retrained their customers to just simply wait for the summer clearance sale, almost like an Amazon Prime Day, and that's what customers are doing. They're just waiting. So consumer traffic is down, same-store sales is down, and they're just barely keeping even on per-ticket sales. So it's really just not a growth story at all. They've got a lot of work to do to regain consumer trust at this point.
And Brian, it is a turnaround story there. What would you need to see specifically to kind of change your mind there? What are you looking for?
Well, I mean, they're happy with the 3% earnings growth projection that they have right now. I want to see that online more with where Walmart is. So if you're going to be, the big retailer that you see yourself being, you're going to have to be more competitive and get from 3% up to where Walmart is in the 8, 9, 10% range. Look, the entire S&P is probably going to grow by 8 or 9% by itself, and you're still less than half of that. You're going to have to show that you're going to be able to grow earnings at least on pace with the broader market if you're going to be anywhere near favorable in our view.
So I guess, Brian, is it bottom line, is your advice to investors in 2026, if you want to pick your spots in the consumer, are you saying, listen, better to stay relatively with those defensive names?
Yeah, quality is going to matter, right? I think the bigger companies that have scale, that can protect their margins through more efficient operations, and these are the names that we're talking about that have just done it better, right? Walmart is a lot bigger operation globally than Target is. It makes it a higher quality name. They're more durable in terms of their top line revenues, and they can defend their bottom line profitability in a little bit easier way because of the scale of operation that they have. Home Depot, again, a much bigger name than Lowe's, and Target really doesn't have a peer other than Ross or some other smaller stores. And so really it's about, not just the defensive nature, but the higher quality balance sheet and the bigger scale of operation is the way to really be defensive in your portfolio in a moment of uncertainty.
Brian, always great to have your time and those picks. Thank you, sir.
Thank you.
Coming up, we find out what most Americans actually spent their tax refund on. That's next on Market Domination. From assessing consumer dollars to energy supply risks, we're digging into it all with the top stories we're watching. Yahoo Finance's Brooke DePalma and Jake Connolly join me now to discuss. We're starting here with the recent verdict in the Live Nation trial, Brooke. So jury finds that Live Nation illegally monopolized the ticketing market for big concerts in the U.S. It's a win for states accusing it of overcharging music fans, pressuring venues to use its Ticketmaster service. What do you make of it?
Yeah, I mean, certainly we're going to see, if not years of appeals here. I mean, there's no way that Live Nation is just going to take this, grin and bear it, and move on. The company's definitely appealing this case. I mean, the fact that they're accusing them of running up prices, I mean, the ticket prices right now are absolutely insane. You go to purchase them, but yet, on the flip side, if you look at it this way, Ticketmaster may be saying, hey, consumers are willing to pay this price. Superstars, celebrities saying consumers are willing to pay this price. They're definitely aware of just how much Americans, consumers across the globe are paying in order to go see their concerts. And so Ticketmaster has sort of floated this around. That doesn't seem like that's going to be the case for much longer. And so from here, could we see divestitures? Could we see Live Nation and Ticketmaster split up? What does this mean from here? There's still a lot of question marks.
Jake, to Brooke's point, it does sound like Live Nation's fighting this one. Per the Journal, Live Nation saying it would ask the judge to find that jurors had erred and overturn their verdict, also challenging the expert witness testimony. So they're not just taking it sounds like.
No, they're not.
Yeah.
But you also got to remember, this merger happened under the Obama administration, and people have been fighting it since that time. There have been arguments that this was going to be anti-competitive, arguments that the company is shutting out venues that won't work with it, trying to kill that revenue. At the same time, I see the Live Nation argument that, as Brooke was saying, if people are willing to pay these ticket prices, if someone will buy their daughter a $3,000 ticket to go see the Taylor Swift Eras Tour,
Which they did.
well, why shouldn't Ticketmaster charge what people are willing to pay?
Right.
I think they've gotten so much bad blood, though, with the public that that's going to be a hard argument to get past the jury.
And also keep in mind, they're not just paying, Ticketmaster alone. You're not just paying that. You're paying for the celebrity. You're paying for the show crew. You're also paying the venue. The venue. How much money do they actually make at the end of the day? They work with so many venues across the U.S., and they probably don't make a lot of money at the end of the day. And so you have all these different forefronts about where exactly this money's all going. It makes you kind of reason, like, okay, a couple of $100 versus $60, kind of, sort of, not really.
You a big live concert fan?
Like, to be honest, no.
Yeah.
Because the ticket prices are too high.
But at the same
time, like, I get it. I get why they are high.
If you are going to pay $500 to go see an artist you like, you would hope that a lot of that money would go toward the artist, but most of it does not.
Yeah.
Moving on, let's turn to, this is right up Jake's alley here. The skies, the IEA sounding the alarm for jet fuel in Europe. So Jake, this is your wheelhouse. Europe has maybe 6 weeks of jet fuel left, Jake, according to Energy Agency head saying. So basically just as we head into the summer.
Exactly, right as you head into summer travel season, all of a sudden you saw the IEA director, Fatih Birol, come out and say, Europe has 6 weeks left. Jet fuel prices in Europe have jumped significantly. They've jumped in the US, but Europe is much more exposed here. The US gets 2.5% of its crude oil and refined products in the Persian Gulf. It's a tiny amount. Europe, that's 10 to 20%. It's a much heavier load. And Brihol's point is, are we going to get to a point where not only are ticket prices going up, as we've seen in the US, as we've seen in Europe, but do we get to a point where your plane can't leave because there's no oil to get the plane off the ground? There's no jet fuel, and he's saying that might not be as far away as we think it would be.
I want to ask you, what's your sense of what this possibly means for the European carriers? I mean, do they start canceling routes? What do you think?
Well, that's the theory, that they would have to start canceling routes. Maybe it's not the short inter-Europe trips that don't take up that much fuel, but are you going to be able to get that flight from Frankfurt to Dubai, or one of those long-range flights? Can you get from Charles de Gaulle to Los Angeles, or do you have to do shorter flights? The airlines are going to get creative. They have to, because what they don't want to do is lose consumers and lose consumer trust over the long term. But at the same time, they've got to deal with the fact that if there's not jet fuel, you can't fly the plane.
Yeah, here's what this agency head said, Brooke. If the Strait of Hormuz isn't reopened, he said that for Europe, I can tell you soon we'll hear the news that some of the flights from City A to City B might be canceled as a result of the lack of jet fuel.
I mean, gosh, I hope that it's not like this where you're sitting in the airport and all of a sudden that's the reason that your flight gets canceled while it's on the tarmac. worst fear as a traveler. But I mean, this is something that we've been hearing from these airline carriers. We saw American, Alaska, Southwest, Alaska Airlines, Southwest, JetBlue, United, Delta, Allegiant. Every single one of those airlines have cut back on their miles here in the U.S. because of the fact that they just simply can't keep up. That fuel cost is so high, diesel costs so much for these flights to continue that they've cut back on their miles. Now to see this in Europe, where they're even more so impacted. Is this a larger trend? How long does this last? Because that was for Q3 of 2026, these companies saying they're going to cut back. So where does this ultimately end up? How far down the line does this trickle to?
And I'll tell you the thing that interests me about this with Europe. Maybe 15 years ago, the US airlines decided to stop hedging jet fuel prices for a lot of reasons. Basically, they won't go lock in long-term prices down the road. They just pay whatever the price is that day. There are legislative reasons, some regulations. The European airlines still hedge prices. They still buy jet fuel contracts several years out to lock in low prices. If it's getting to the point where they're having to cancel routes, it's not a problem of price. It's because the jet fuel supply literally isn't there.
Yeah, it's crazy.
All right, take a look finally here. Here's one, Brooke. The consumer feeling the squeeze financially. They're taking advantage of the extra cash from tax refunds. So this is per Bloomberg. Many U.S. taxpayers, Brooke, using their tax refunds to pay down debt or using refunds to catch up on bills, shore up finances, rather than splurging on some discretionary item.
And you know what's so fascinating is that heading into this year, what we heard so much was the fact that Americans are going to have extra cash in their wallet to splurge, to do things that they want. Maybe use it to travel, use it to splurge on luxury goods. This had everyone in the industry excited. I even remember that on February 12th, I had asked McDonald's CFO, I said, what did larger tax refunds mean for you guys? And he said, they're not necessarily focused on the external environment, but what he did say was that, hey, extra cash in Americans' wallets is a good thing. And now this just goes to show the impact the gas prices have had on Americans. They're maybe thinking twice. Their sentiment about how the U.S. economy is going has come down. And so maybe now they're thinking, okay, is now the time to pay off that debt? Because I'm a little bit worried about the way things are going.
I would have absolutely, completely blown every cent of my refund. I had a lot of things I wanted,
100%.
But it was terrible.
100%.
It was so disappointing, Jake.
Yeah, but not for everyone. Not for everyone.
Some people are getting refunds.
$3,000,
$13,000.
Not Jake and Josh.
Not Jake and Josh.
I mean, not Brooke either, guys.
Terrible.
Yeah, I'll tell
what do
you
you think it tells you about the American consumer?
Yeah, you look at some of the credit card debt and credit card spending data that Bank of America tracks. Total credit card spending down 2.6% year over year last week, but gasoline spending up 20% every single day of last week going on the credit card. So what does that tell you? That's where money's going right now. You're taking money out of the discretionary pool and you're pushing it toward the necessities, toward food prices, toward gasoline. So if I'm the average American who's benefiting from the one big beautiful bill, getting my tax refund, what am I going to do with that money? I'm either going to pay down debt, as you see happening, or I'm going to push that toward necessary expenses, toward filling my car up to go to work.
What do you spend your refund on?
Weddings,
Smart.
bachelor parties.
Smart. That's smart.
Went right towards some one of the vendors, getting married. It's a big expense, guys.
Brooke De Palma, 2027.
2027. I'm saving up, guys. I'm saving up.
Brooke, Jake, thank you both. Appreciate it. Coming up, I speak to the former CEO of Barstool Sports about her latest media venture. Don't go anywhere. The media landscape is changing as companies battle for viewers' attention. Subscription prices are rising. News outlets and now even Disney are announcing big layoffs. And Paramount is trying to buy Warner Brothers Discovery. So where is the smart money going in media? With me right now on this is Erica Bayers-Vadon. She led Barstool Sports from 2016 to 2024, taking it from $15 million valuation to $100 million. She then led Food 52 through its restructuring. Now she is leading her own media venture. It's a women-led company called Mule Media. Erica, it is great to see you. So you say here, you put it like this, Erica. You say Mule Media isn't so much really a content company. You say it's a community company. What does that mean in plain English?
Yeah, in English, it means that it's a company that's created by people, with people, for people, right? 50% of all content right now on TikTok is AI generated. So what humans are going to be looking for is actual connection, to belong, like helpful advice, a feeling of value that they get from other people. And what we're building with Mule Media is a platform. We talk to 3.5 million women every month, and they're offering tips, information, advice to one another. And it's not from an AI bot, and it's not from a random influencer. It's from someone you see at the grocery store or someone you see in the elevator bank. So it's real people connecting to real people.
And did I read this right, Erica? You're combining two communities, it sounds like, Work Like a Girl and the Local Moms Network. Just explain that and why does that combination work?
Yeah, it's awesome. So one is working women have a bunch of challenges and opportunities, and so do moms, whether you're a stay-at-home mom or you're a working mom. Local Moms Network has been around for 10 years. They're celebrating their 10-year anniversary. Awesome company, totally entrepreneurial. Women run local sites. They create value and content for other moms in their communities. Work Like a Girl started on Slack, and it's a community of professional women. You want to talk about AI, you want to talk about technology, you want to talk about fintech, you want to talk about your industry. Do you want to look for a job? You want to find other people who have your job. That's what Work Like a Girl does. So we're combining the two, and what we'll take is the local power of the Local Moms Network and the social power of Work Like a Girl, and create value for women in their communities, meeting them where they are with something that's value to them right now.
And Eric, how does Mule Media make money? Like, what's the business model?
Yeah, great question. So we'll make money a whole bunch of ways. Barstool Sports was a great example of this. We had live events, we did subscriptions, we had pay-per-view, we had a huge advertising business, we had a merchandising business. Mule Media will be very similar. We'll do live events, we'll sell ads, we'll do partnerships, we may do subscriptions. I doubt it in the short term. We'll definitely do merch. And so we'll have a diverse monetization strategy because the content that we create is diverse. We'll do written content, we'll do live events, we'll do video, we may do podcasts, we may do big conferences.
What's the, I mean, obviously there's a lot of online communities, Erica, so how is it defensible, the company? Like if it's successful, how do you prevent it from being copied?
Look, if you look at Local Moms Network, it was founded by an incredible woman who's my co-founder in Mule, Layla Lieski, and what she did 10 years ago was started to create something that served her. So yes, people will want to create community, but community requires authenticity. It also requires consistency, and it's something that takes years and years to build.
Can I ask you why Mule?
Oh, it's a great name. I mean, it's the weirdest name ever. Layla came up with it. Mules are resilient. It's a combination of a jackass and a mare, which is kind of perfect. They're intelligent. They're sure-footed.
They're pushy.
They're pushy.
They can
they're
bite.
stubborn. They can bite, but they can carry a whole lot, and that's exactly the metaphor.
And honestly, they're kind of adorable.
They
it's
are.
An adorable
They're real
animal.
cute.
You've been, just so the audience understands, we mentioned this, but you worked in media a long time.
Yeah.
You worked with Portnoy at Barstool. I am curious to sort of get your broader take, Erica, when you think about the media landscape.
Yeah.
How do you see it kind of generally evolving in the next 5 years, 10 years? And why is Mule well positioned to capitalize on those trends?
Awesome question. So look, when you look at most of the businesses, media businesses that made money from search traffic, they are all for sale. Everything in media is for sale right now. There, you see the big guys are merging. Everything in the middle is for sale. And the reason it's for sale is that traffic is no longer going to be coming from search, right? Traffic happens on social, which is mostly contained into the platform you're on. Traffic will be far more generated from AI. And there is also concurrently a backlash against AI and against social, where people are looking for in real life events. They're looking for content that has meaning. They're looking for communities to belong to. And that's why Mule is on the cutting edge of that. It will use social as a distribution tool, but it will bring people together in a physical manner, in a local manner, and in a relationship. So it's ongoing.
Do you feel, Erica, like media obviously became obsessed really with clicks and scale, and are you kind of suggesting you see that sort of transition now? You're going to have sort of different North Stars, creator, community?
Exactly, yeah. If you look, like, everybody was chasing page views, and then everybody was chasing video views, and then everybody was chasing followers. And the reality is, it doesn't really matter how many followers you have, it's how much engagement per follower. And a platform like Work Like a Girl or a company like Mule Media, the engagement per follower is super high. They are talking all day in Slack. They're connecting with one another on a playground. They're meeting up in an elevator bank. Those are invaluable connections that can't be bought, can't be served up. AI isn't going to make the content that does that. And that's the difference, which is the metric for media will change to engagement. And this is a company that is highly engaging.
Spin ahead. How are you going to define success for Mule Media, like 3 to 5 years out? What are your metrics, your variables, your benchmarks?
It will be how many local sites do we have? You know, right now we have 100 local sites. We reach 3.5 million women every single month. What if we reach 30 million women every month? What if we're in 100 different industries, not just 50 industries, which is what we're in today? So success will be finding women to run these experiences in all different industries, all different cities, all different towns. And then it will be the number of women who we can touch and we can affect through those communities.
I got to ask you about Portnoy. What were important lessons learned working with him?
He's the best. Like, you know, he's the consummate content creator. Like, he's in the middle of the Alex drama right now. And I texted him this morning. I was like, you're a genius. And he's like, I know, it's crazy. But look, what Dave really understood is how to make people laugh. He's incredible at that. He also was really good. He had an incredible eye for talent. He still has an incredible eye for talent. And then 3, he's funny and he's unafraid. And a lot of times when you find creators that are afraid or reserved, it doesn't really work, and that's why he always works.
Yeah, Portnoy makes me laugh all the time.
All the time.
Erica, great to have you, especially on set.
Thank you.
Thank you. Coming up, we've got you covered through the closing bell on Wall Street. That was great, man. That was awesome. That was really good. That was awesome. stocks ending the day higher here, and our own Jared Blickery is standing by with the latest. Jared.
Well, thank you. We got some records to talk about and some really long streaks, but not in the Dow. This is the Dow's price action behind me. You can see it's closing fairly close to the highs of the day, but we're only talking about 115 points and about 0.25%. NASDAQ Composite and the NASDAQ 100 have just completed 12 straight days, have not seen that in years. The tech-heavy index up about 1/3% here. S&P 500, that is another record close for its second day straight. And let's talk about small caps, too. S&P 600, that is a record high for the small caps as well. Let's turn to large cap sector action now, where we see energy. That was the leader today. Haven't seen energy leading in maybe 12 days, this entire run up, but it is today. And then following that, we got communication services and tech. Those are two mega cap sectors. And then to the downside, healthcare was the worst off, down about 0.8%, followed by consumer discretionary and industrials, each of those down 0.5%. You can see inside the NASDAQ 100 kind of a split board here, including the mega caps. You got Tesla, Nvidia, Apple, Alphabet all down just a bit, Apple off more than 1%, but Microsoft up more than 2%, and then Amazon, Broadcom, and Meta each up under 1%. And I was talking about softwares versus semis before. Software is still racing ahead. They are by far the biggest leader this week in a lot of the sentiment indicators that I track, and they are outpacing semiconductors today and for the week as well. Here's semiconductors, and you can see kind of a mixed board there. ASML and Taiwan Semi down 5% and 3% respectively, although we do have some nice returns for AMD up almost 8%, and Intel, which is one of the strongest stocks in the S&P 500, it is now up to 85% year to date, just blasting through that old high that we saw in January. Let me finish up here with the Dow, and we can see besides some of the mega cap sectors, we got JP Morgan up 1%, Verizon up over 3%, IBM and Cisco and Salesforce up more than 2%. Meanwhile, industrials are a little bit weak here, Boeing off about 2%, Josh.
All right, thank you, Jared.
Thank you.
Let's take a pulse check of the markets now and assess whether the S&P can sustain its momentum following record highs. Let's look at Polymarket odds on where the S&P 500 will close at the end of this year. Under 6,000 is currently the most likely among prediction markets traders at 33%. My next guess price target for the S&P this year, 7,000. Let's bring in now Thomas Carroll. He is Stifel's Vice President of Portfolio Strategy. Tom, it is good to see you. So, okay, so your target for the SPX this year, 7,000. Tom, that has to be probably one of the lowest on the street versus your peers there. So maybe start there. How come, Tom? What are you seeing perhaps that maybe others don't?
Hey, Josh. Well, first off, thank you for having me back on here. I think the last time we spoke, since then, we have seen a 10% correction followed by a rally back to all-time highs. We saw oil go from $60 a barrel to 120 and now back to 100. Investor sentiment has completely flipped. Even a couple weeks ago, I was asked if I needed to cut my price target. Now I'm being asked if I need to raise it. So it's been a breathless start to the year, but we're pretty comfortable where we stand as things are.
When we talk about this kind of valuation compression you see there, Tom, can we quantify that? I mean, how much compression are you forecasting?
Yeah, well, that's our main concern. We're seeing a pretty strong start to the earnings season so far, but that was to be expected. We had a pretty strong forecast coming this year of roughly 15% earnings growth year over year, which is very strong. And now it is true that roughly half of that is from semiconductors. But as you said, our overall concern is the fact that we are growing into the multiple, which is causing the market to level out in this low 7,000s range, which is what we continue to expect.
You point to yields and credit, Tom, as key pressure points. Which one worries you more right now, Tom?
Well, I think just if we look at the past month of price action, I think credit's probably the larger driver of markets at the moment. You were talking about, this growth stock rally that we've seen over the past couple of weeks. Well, a lot of that has to do with the war risk premium coming out of the credit market. So when we initially had the oil shock, the credit spread, which is the yield that is charged by corporates above U.S. Treasuries, it tracks the S&P 500 valuation very closely. That fell very sharply because of the risk premium from the oil shock. However, once the market began to see ships move back through the Strait of Hormuz, all of a sudden that risk premium began to fall quite a bit, and we saw the valuation in the market move back up, and growth stocks are always the most sensitive to the valuation expansion, and we saw us move right back to our price target. So we think that is going to be what we're looking at more this year, is continued chop with that corporate credit spreads, keeping the valuation down and hitting our price target.
As for the American consumer, Tom, give me your take there. You don't sound too constructive.
Yeah, well, we have a roaring AI CapEx cycle, which is actually turning inflationary for the overall economy at the same time that we've had oil move from $60 a barrel to nearly $100. And this is hitting the consumer at a time where they were already quite vulnerable. The job market was very weak coming into this year, but now a kick up in inflation makes it a very difficult environment for the consumer. And ultimately, the consumer is the economy. It's 70% of GDP. And so if we do see consumption slip, it's going to have important ramifications for the economy, and we believe markets as well.
You know, when those big banks reported, though, Thomas, and all those big bank CEOs, you saw that they were asked point blank about the consumer. They were generally pretty positive. I mean, they hadn't really, I guess if you were paraphrasing it, they didn't really see any big changes. Sort of, you know, generally they say healthy, resilient. I guess is your point there, maybe they're looking backwards?
Yeah, I think we had a pretty strong finish to GDP last year, and I think some of that data is probably reflecting what we've already seen. I think it's really difficult to know, just given the effects of the oil shock had just happened, really the effects on the consumer yet. I think it's going to be something that plays out over the next few quarters.
On AI, this is interesting, Tom. It sounds like you're suggesting you think AI CapEx could actually slow from here. How come?
Yeah, well, we would say our bigger concern is not necessarily that it's slowing at the moment. We actually think that it's actually turned inflationary quite a bit of the CapEx. So these first quarter numbers we think are going to be pretty strong. Our general concerns have more to do with the fact that free cash flow for some of these big spenders is actually moving negative, and in order to fund their spending, they're going to have to go to debt markets to borrow, which creates that overall credit risk, which lowers the valuation, which is a concern for the S&P. And that calls into question some of the back half CapEx estimates that we're seeing, if they're able to even deliver on those, just given the scope of the spending that they're already having to do.
Where's the Fed in all this, Tom?
Well, I think one trend that's very interesting to us is, you know, if we think about the technology inflation cycle, really for 50 years, it's been deflationary. Well, for the first time in 50 years, that's turned inflationary as well. So we're seeing inflation pick up across the board, whether it's oil, technology. We do not see a 2% PCE target anytime soon, which is the Fed's stated mandate. It's been 6 years since they've hit that mandate, which calls into credibility how committed is the Fed really to their 2% goal, and do they risk a bond market riot on the long end if they choose to not target the 2%? It's not a great spot to be in for the Federal Reserve, I would say, and we're expecting quite a bit of volatility around the press conferences this year.
So let's end here, Thomas. Just add it up for us. Bottom line, how do you want to be positioned in the market broadly?
Yeah, we think broadly we're seeing the tale of two economies, we're calling it. We have the ripping, roaring AI CapEx cycle, which for us, the way to play that is what we call cyclical value. Anytime we see very strong rates of investment, it makes sense to be overweighted capital-intensive industries that do well when there's these massive investment cycles. But at the same time, as I said, the kick up in inflation also hurts the consumer, which is the larger share of GDP, which makes us want to have more of a defensive bent. So we're recommending what we call a barbell approach between the cyclical value side of the market and the defensive value side of the market, as we think there's going to be some issues with the consumer in the back half of this year.
Tom, great to see you as always. Thank you.
Thank you, Josh. That was great.
And for more Polymarket odds, scan the QR code on your screen to go to Yahoo Finance's Prediction Markets Hub, powered by Polymarket. Coming up, Netflix earnings about to drop. Stick with us. Now for some earnings, Netflix is out with its first quarter results, and Yahoo Finance's Brooke DePalma has the latest. Brooke, what do you got?
So Josh, this quarter looking pretty good, but obviously investors are fixated right now on their second quarter outlook. The stock dropping as much as 9% in after-hours trading after Netflix just dropped this report. We saw this company, of course, the media giant, put out this outlook that investors aren't super excited about. Revenue for the second quarter is expected to come in at $12.57 billion. The street had wanted more than that. Earnings for the second quarter expected to come in at 78 cents versus the 84 cents that the street was looking for. Operating income outlook also coming in, or expected to come in lower at $4.11 billion, far less than the $4.34 billion. Also want to clarify, right now, revenue for the second quarter is actually expected to come in, let me just find it really quick, expected to come in far lower than what the street had expected, looking for that exact number right now. So clearly this is an outlook that doesn't have the street super excited, especially after this was supposed to be momentum for Netflix, considering the fact that they lost that deal with Warner Brothers, but now they're ultimately getting that $2.8 billion termination fee as well from Skydance, Paramount Skydance. And so this was, heading into this report, there was a lot of excitement that investors had around this. And this is necessarily not exactly the outlook that the company had wanted. I do want to clarify quick on that second quarter revenue outlook that the company is expecting. That's $12.57 billion compared to $12.64 billion that the street was looking for.
What do you make that Reed Hastings news?
So Reed Hastings expected to step down from the board once his term expired. I mean, you're kind of losing the heart and soul of this company. Reed Hastings was the co-founder. He developed this company, the DVD mail-in. That's what Netflix originally was known for. And I think that, you hear that this executive who really has built so much of what not only Netflix is, but really streaming services in general, it feels like a part of the company will be missing, and maybe investors sort of weighing in on that one too.
All right, thank you, Brooke. For more on Netflix and the streaming space, let's welcome in now Bloomberg Intelligence Senior Media Analyst, Geetha Ranganathan. Geetha, it is good to see you. So Netflix report, the stock is getting nailed here in the after hours, Geetha. We're down here about 9%. What do you make of the print? What do you make of the reaction?
The print for the first quarter was definitely good. We had revenue come in above expectations, operating margin above expectations. So everything that we were looking for, they more than delivered on. The problem really here is that the report hasn't done much to assuage investors in terms of the future growth momentum. So the guidance for the second quarter definitely a little bit light, and I think investors are already wondering if the recently implemented price hikes might, have a little bit more churn, might cause a little bit more churn, might cause people tiering down to the lower price tiers. So that could be something that, management might have to weigh in on the earnings call. And then, of course, the EPS numbers also a little bit lighter than expected, which basically, Netflix kind of addressed that in their investor letter, saying that this is because the content amortization that is going to happen in the second quarter is going to be the highest. It's going to obviously ease a little bit into the second half of the year. And so I think we're kind of seeing that flow through to those EPS estimates as well. But overall, as we kind of zoom out, this was really supposed to be their big comeback quarter. This was supposed to be them telling us why they're going to do just fine without Warner Brothers Discovery. And I'm not so sure that this report necessarily does that.
Geetha, they were prepared to write a big check, obviously, for WBD. Instead, the Ellisons make their move and swoop in and win that one. I'm just wondering, looking ahead now, Geetha, how does that change how this company thinks about its catalog, its licensing strategy, its growth strategy?
Yeah, that's a really good point, Josh. So, they already, even before they announced this WBD deal, and, they were obviously willing to spend $72 billion for that. Of course, they didn't get into the bidding war, which I think was definitely a good move. It led to just a huge amount of debt and created a lot of integration and other execution risks. But, kind of looking at the path forward, it was really going to be all about organic growth and all about maybe smaller acquisitions. So we already know that they spent about $600 million for, the Ben Affleck company, which is more an AI tools-based company, Interpositive. The question is, would they go after other studios, maybe smaller studios, like maybe a Lionsgate or, an AMC Networks? That has always kind of been the question. Do they have the financial firepower to do it? Absolutely. Do they absolutely need to do it? I don't think so. They've managed to build this business from the ground up, without any major acquisitions, building it to almost, 325 million subscribers. I mean, of course, one can argue that they've captured all the low-hanging fruit, and it's going to be harder and harder to get more growth from here. And competition is only getting tougher, especially with the likes of YouTube and TikTok. But I think Netflix still has a lot of levers that it can pull. I mean, they obviously have good pricing power. They obviously have a whole new revenue stream that they're building on advertising, and they have, they've committed to making a pretty big content investment this year itself, Josh, which is $20 billion. It's more than they typically invest in content, and so they're trying all kinds of different things. They're really diversifying their portfolio when it comes to content. We're seeing them really increase the speed and velocity with which they've gone after, live and sports programming. So all of that, I think, should ultimately help them kind of really future-proof their catalog, and kind of really build that momentum. But again, this particular report not necessarily helping their case.
Yeah, I mean, you're seeing obviously real disappointment here, at least initially in the after hours, Geetha. I guess your point is, Geetha, you would argue, to summarize, and correct me if I'm mischaracterizing you do think ultimately they've got the content, they've got the catalog to accelerate engagement growth in the quarters ahead.
They absolutely do. I mean, we've already, yes, engagement has plateaued a little bit, and maybe that was part of, the whole investor anxiety. Is that the reason that you went after, Warner Brothers Discovery? I mean, that was the top question, the burning question in everybody's mind. So they do have to come out with, metrics that show that they're able to increase engagement. But whatever we've seen so far, Josh, definitely points us, gives us a lot of confidence in their catalog. And they've had a steady stream of hits, quarter in and quarter out. And we think that, just kind of looking at the investments that they're prepared to make, we think that they can definitely continue to build on that over time.
What about Reed Hastings, Geetha? What do you make of the news there?
I'm not necessarily convinced that, it's going to sway investor sentiment or it's going to be a negative. I mean, we've seen him kind of on the sidelines now for many, many years, as Ted Sarandos and Greg Peters have kind of totally taken over and have been running the show. So yeah, I mean, maybe on the margin a little bit. He is, after all, the founder of the company, but I don't think it's necessarily going to have any huge impact from a sentiment perspective, or definitely not on the day-to-day running of Netflix.
In terms of risks ahead for Netflix, speaking of Reed Hastings, Geetha, he said this, interesting quote, and shout out to Rich Greenfield, by the way, for flagging this one. He said, does AI transform content creation in ways such that young people only watch YouTube? Hastings asks. And YouTube content boosted with AI becomes cool and sexy enough that takes all their time. That is an interesting question posed by Reed Hastings. I'm just curious what you make of that. How much of a risk is that?
Yeah, that is a huge risk. I mean, it's not just YouTube, Josh. I mean, it could also be TikTok. It could be any kind of short form video. And this is really the problem with AI. And we're still kind of trying to figure this out. AI is pretty much at this point still a double-edged sword for all of these media companies. Yes, it can reduce content costs pretty significantly. We think almost by 10 to 15% overall, which could be a huge, windfall for companies like Netflix. But at the same time, it's also democratizing content creation, right? It's kind of really blurring the lines between user-generated content and premium content. And that's the risk Netflix faces. And I think that was the reason, one of the reasons at least, why they wanted a catalog like Warner Brothers Discovery to kind of, insulate them a little bit. We're going to have to see what exactly they do. I think they're trying to kind of build out their portfolio. So we saw them kind of make a bigger move into games. We're obviously seeing them invest or prepare to invest more in sports and live content. But that is definitely a huge risk that they are going to have to contend with. Although I think they will be well positioned to handle it in the coming years.
The consumer right now, Geetha, obviously facing some headwinds, sticky inflation, prices at the pump. I'm curious what kind of risk you think that poses for Netflix.
Yeah, so pricing power has always been, the ultimate question. I think the way that the market views Netflix is it's pretty price inelastic. I don't think people are necessarily going to cancel their subscriptions. Yes, there is the risk of, down tiering, but I think this is where Netflix has a really smart strategy. they can raise prices on their ad-free tiers because they do have a very, very competitively priced advertising tier. So remember, their advertising tier right now, Josh, is priced at $9 per month. That is about 25 to 30% cheaper than rivals ad-based products. So if you compare it to a Disney Plus or an HBO Max, I mean, those are all substantially more expensive. So they're still kind of the best value in the market out there. So while there is a slight risk that people could downgrade, I think Netflix is still in pretty decent shape overall.
How would you grade their traction and success with that lower tier ad business so far, Geethan? What do you see ahead?
Pretty good, Josh. So the metrics, I mean, they haven't given us a whole lot of detail here. So we know that ad revenue, and they just mentioned this in their newsletter that came out a few minutes ago. They said that they're on track to, report about $3 billion in advertising revenue this year. That probably translates to about 230 million ad viewers, and we're talking maybe about 60 million subscribers. So that is still a pretty decent number. So we think that in the markets where advertising has been introduced, the ad tier is actually making up a third of the subscriber base, which we think is really good progress considering that, they're still very, very new to this. So as they kind of get better in terms of the technology, as they're able to improve their ad pricing, as they improve the programming that kind of translates well for advertising, we think that it presents a lot of future growth potential.
Geetha, we're always so lucky to have you. Thank you.
Thank you so much, Josh.
Coming up, we look at how the conflict in the Middle East has impacted luxury sales. Don't go anywhere.
Thank you so much.
Hello and welcome to Asking for a Trend. Hopes for recovery within luxury retail has come to a halt as losses from the high-spending Middle East market has taken a toll. Here with a closer look is Pauline Brown, former chairman of North America at LVMH. Pauline, always great to see you. So you say here that luxury isn't structurally broken, but it is more sensitive to global shocks. Let's talk about one of those shocks, and that would be, of course, war in the Middle East. How important, Pauline, is the Middle East to the luxury market? Like, help us frame and quantify it for us, and then walk us through how well, Pauline, that market is actually holding up right now.
Yeah. Well, first of all, historically, I would say as a region, not that important, which doesn't mean the Middle Eastern shopper was not important, but historically, they would be buying these goods in London, in New York, other places they travel to. I would say over the last 5 to 7 years, there's been much more drive to purchase luxury product at home, and it has been one of the bright lights in an otherwise very challenging market. So it has become increasingly important. But there's a second piece, which is really what's affecting most of the major players right now. It's not just the local Middle Eastern shopper. It's the fact that the Middle East has become more and more a hub for global travel, whether you're heading to Asia, you're heading to Europe, and it's been a place where people have increasingly stopped over for a period of time from other parts of the world. So I think it's being hit right now on both fronts, on the fact that it was a growing population or growing wealth population within, and the pass-through has significantly curtailed.
Do you think, Pauline, there is some risk that the Middle East, how we think of the Middle East, it becomes this hub of travel and tourism, a hub for luxury? Is there a risk that changes, Pauline, after this war, that maybe our perception of the Middle East as that hub could be derailed or dented in some way, fundamentally, structurally?
Well, I think it depends how protracted the war is and instability in general. I think if this comes to resolution by the summer, that things will, in time, go back to where they were. I think if this escalates from here, it will have a very, very long-term effect on our perception of that as a desirable place to go or to live.
Are you seeing ripple effects, Pauline, from the war? Is it showing up, for example, in luxury supply chains already?
So in a small way, it is showing up in luxury supply chains, but I think where the single biggest effect outside of the region is travel to Europe. So we're seeing the sales across the board, every luxury player in Paris, in the UK, in Switzerland, were significantly down. Interestingly, not as much in Italy, but the continent in general was hard hit, and that is a tourism issue.
For that luxury consumer, Pauline, I'm curious, what are they spending money on? Like, how has it shifted versus if I asked you that question 3 years ago or 5 years ago?
So 5 years ago, I would have said a lot of the growth was coming from two sources. It was coming from the new wealth created in China. And by new wealth, I'm also talking about upper middle class, not just ultra wealthy. And it was an aspirational customer in other parts of the world, in mature markets, US, Europe. And there was an awful lot of post-pandemic travel that was also spurring a boom for luxury. Today, the only healthy segment within all of that are the ultra wealthy. So if you look at certain brands like a Loro Piana or a Ferrari or an Hermes, they have withstood the headwind better than others. Those that have been growing and appealing to more of a mass market are particularly hard hit right now.
You don't seem as confident in the aspirational consumer, I think, as you put it, Pauline. How come? And how do you define that consumer?
Right. This is a consumer who does change their lifestyle when housing prices go down, who does change their decisions to travel or to spend when macroeconomics are not favorable. So it's a much more sensitive customer, sensitive to these variables. What we're seeing with the ultra wealthy, they don't change the amount they spend. They may change the occasions that they spend on. There has been a shift for some time now, even among that segment, on spending more for experiences, spending more on health and fitness, on luxury travel, and a little bit less on fashion, but they'll still spend on fashion. So that's really the single biggest difference between the two.
Talking about the American consumer, Pauline, we just heard from the big banks, and the big bank CEOs were asked, very targeted questions about how the American consumer is holding up. And really broadly, it seemed like they thought not much has actually changed. That, generally speaking, they said healthy, resilient. But of course, the American consumer, we're often talking about a lot of different kinds of consumers there. For the luxury American consumer, the wealthy American consumer, what are the trends you're seeing, Pauline?
Well, this was the best quarter I've seen in a good while in North America for the luxury goods companies, for across the board. LVMH included had a pretty robust growth number for North America. So that says to me two things. Number one, it says that we feel more insulated from the effects of what's happening, the instability, geopolitical instability elsewhere. Number two, that we're shopping at home more. Perhaps some of that money would have gone overseas in prior quarters or years. Number three, that the wealthy in America, particularly in tech-related fields, have never been more frothy, and they're living to prove it. And there are certain brands that have been appealing to the tech entrepreneur, and they're really well positioned right now. Brunello Cucinelli would be the standout.
Were you surprised at all that the kind of American luxury consumer held in there, Pauline? I ask only because, the market, listen, we've clawed back all our losses here from the war. The S&P 500 posts a new record close, but it has been volatile, right? March, it was a roller coaster. Are you surprised at the resilience?
Well, you have to keep in mind that you're anniversarying off of some very soft numbers. So I wouldn't look to what we see right now as something we should go out and celebrate. I think there's still a lot of sensitivity. I think it's very brand by brand. So when you're looking at the results of the larger groups, it's sort of camouflaged across, in the case of an LVMH, 70 to 75 different entities, and you'll see a lot of variances across the group as to which ones are actually growing and which ones are decelerating here in North America. Was I surprised, though? I actually was. I was, because the other thing we are dealing with here at home is a major restructuring of the wholesale channel. The brand's largest retail customer, Saks and Neiman's, which are merged, is currently in bankruptcy and going through a lot of structural changes within the distribution. So all of the growth that you would have seen would have come from direct to consumer.
Finally, Pauline, we talked about the American consumer. What about the Chinese luxury consumer? What are the trends?
Yeah, it has been very negative for a couple, I'd say 2 years now. This was the first quarter where it seemed to stabilize. The concern among the players is not that the Chinese customer is ever going to go away. It still is. It was sort of hovering between number one, number two of the largest source of spend for these companies for the last many years. The growth did decelerate a lot from where it was, but it wasn't. We always knew it wouldn't be sustainable. I think the biggest watch out, though, is that the Chinese brands are going more and more, or the Chinese consumers are turning more and more to local brands. And in fact, just today, Kering announced a minority investment in a Chinese luxury brand. So their biggest threat is not just the growth of the consumer spend, but it's really the local competition that has come a long way.
Pauline, as always, great to have you on the show. Thank you.
Thank you.
Stick around. Much more As for Trends still to come. Chipmaker Taiwan Semi reporting a 58% increase in first quarter profit, topping estimates as demand for AI chips remains strong. Julie Hyman spoke to Bouquet Capital Partners Kimberly Forrest and Freedom Capital Markets Paul Meeks about TSMC's results and the outlook for the AI trade.
I was really struck by Taiwan Semi coming out and saying, we went back out to all of our clients and we said, are you sure about the spending? And the clients basically said, yep, we're sure. And so things continue to be going apace there. What stood out to you from those numbers?
Well, I mean, this is the whole key behind why I am watching Taiwan Semi so closely now. It used to be kind of something that I'd watch at the periphery of what I do, and it's because it is a harbinger of AI spending. And I think that's smart that the company has gone out and said, do you really have these, orders? Well, maybe not in hand, but think they're pretty accurate. And it's very comforting to people who are investing in AI, which is probably everybody, to hear those words of comfort. So I think that's really important that the company did that, and they talk about it on the call.
Yeah, and what about you, Paul? Did this, I mean, it seems like lately the sentiment has been swinging back in favor of CapEx, in favor of, it helped that all these stock prices came down. That helped sort of alleviate the bubble talk. But the demand has also helped alleviate the bubble talk. So, was this sort of another reassurance on that front?
Clearly a reassurance. The demand is insatiable. Here's a data point. At the beginning of this year, the bulls, and these are the bulls, not the bears, were expecting Taiwan Semi to have 26 revenue growth of about 30%. Now it'll be much higher than that. And if you analyze their guidance for this quarter, the quarter that we're currently in, they are annualizing at a 46% run rate growth. So yes, this is a clear confirmation. And I will tell you from my experience of covering Taiwan Semi for a long time that this is not necessarily a promotional management team. So when they're giving us this type of commentary and this type of guide, I think it's very bullish.
I was also curious, over the last 24 hours or so, a story came out about Elon Musk really pushing his team forward on their chip making ability. How realistic? I mean, we hear lots of promises from Musk. Some of them get realized, some of them get realized with a lag, right? Do you think that he's going to really provide a viable competitor to some of the other chip makers? And, what does that competitive landscape look like overall as well? Kim, you first on this one.
Sure. Well, although I don't own any of his companies because, I don't know that he cares about shareholder value, which is a big thing to me, I think it's really foolish to count Elon out in any kind of direction that he would go. And that's largely because he has a track performance of doing the incredible. So that being said, this is a matter of timing. It's going to take a while to build these fabs, design the chip, get everything right and start actually impacting the companies that do actually ship chips now. But there are a lot of companies that are trying to make their own brand and tailor the chips to how they're using the compute. This is not new, and I think everybody really understands that investing in this area. Taiwan Semi is a fabricator, so consider that maybe Elon would contract with them for a while as his actual fab plant gets up and built. So there's always that to consider as well.
Well, and there's, it is interesting because in the past, fab wasn't always a great business, right? That's why there aren't more of them, I guess, is one reason. It's a difficult business to get into. Historically, semiconductors were very cyclical in terms of pricing. And so, Paul, when you look at, this push of, expanded manufacturing capacity in the U.S., maybe additional players, maybe Intel's finally going to come to the table with something viable. Do you think that those are good long-term investments potentially?
I do not. I'm much more bearish on this announcement than I guess the rest of the panel here. So first of all, maybe, and it won't be anytime soon, they'll be able to design chips. But if you're going to manufacture chips, just leave it to Taiwan Semi like everybody else does. I have very low confidence that even Elon Musk can pull this off. And then you're getting into bed with Intel. And Intel's best known for the last couple of decades at sucking at manufacturing.
But to be fair,
So
I mean, Paul,
two bads don't make a good.
Yeah, just to push on the other side of that a little bit. I get what you're saying from a pure profitability standpoint. I do understand the prospects of the rationale from a geopolitical standpoint in terms of trying to diversify away from TSM.
Yeah.
Oh, yeah. No, I definitely agree with that. There's a theory that they should do it. I applaud that. And, as an American, I'd love to see, more semiconductor manufacturing domestically. However, very difficult to do, many years out. And the manufacturing portion of all this is even further out. And yeah, when I read that announcement, I'm thinking I'll believe it when I see it.
Fair enough. Kim, you go ahead.
So, just let's level set this. This is the guy who makes rockets return and reuses them, and NASA used to just throw away the boosters. And the whole thing is so miraculous. And no, I am not in the haze of Elon worship at all. But just looking at what he has been able to do, granted with enough time, but he sets ridiculous goals and then somehow gets his employees to meet them. And that, I think, is something that can't be discarded.
Right. Whether he can do it is one question. Whether one should invest in that is another question.
Exactly.
And whether it should be done for, again, geopolitical reasons is yet another question. So there's a lot to talk about with that. But I want to turn to another question that I think is interesting that Derek Thompson, the Substacker, wrote about this morning that my colleague Miles Udland and I discussed earlier, which is there was a lot of hand-wringing about CapEx, right? Sort of going into the Iran war, that was one of the things that was pushing down some of these stocks. That seems to have melted away, in part because the stocks have come down, but in part because you get like Anthropic starting to put curbs on the compute that people can use because they're running out of capacity. So, Kim, how do you think this plays out? I mean, does this mean that the demand for compute is only going to increase from here, and therefore you got to buy everything you can that is in that infrastructure space?
Well, as much as I was a cheerleader on Elon, and I am a cheerleader on AI, having been a software engineer in AI, I really understand what the potential is. But right now, it's potential. We have a lot of companies nibbling away at using AI, and it's unclear that the large language models that take so much of investors' mental space are actually the model that is going to be used. And in that, the whole value issue is how much are people willing to pay, and people being companies that are going to access these models, how much are they willing to pay, how much CapEx is going to be needed in perpetuity. We keep having to train models. We don't really set it and forget it. So all of that is a bunch of unknowns. So as a somewhat risk-adverse tech investor, if that's not an oxymoron, I am very cautious about saying today's compute is what we're going to use in perpetuity, so get ready, let's pave the earth in data centers. No, I don't believe that. So I'm cautious, and I think investors should be too.
Stick around, much more Ask Rich. Before we go, be sure to check out 2 new shows here on Yahoo Finance. Real Money with Ross Mack kicks off on Friday with a new episode. He answers your questions, giving people actionable advice to help give them control of their financial futures. And starting on Monday, get your crypto fix with Scott Melker on The Daily Wolf. You can catch him on Yahoo Finance on weekdays starting at 12 p.m. Eastern. That's a wrap on today's show. Thanks for watching.